In the immediate aftermath of Donald Trump's November 2024 election victory, newly released December 2024 data on foreign holdings of U.S. Treasury securities reveals a striking shift in global investment patterns. Many of the world's largest holders of U.S. debt, tracked among 20 major economies, have notably reduced their positions in U.S. Treasuries. Out of the 20 economies, 16 have reduced their holdings, signaling growing concerns among global investors and central banks. The most significant decreases came from traditional allies and economic powerhouses, with the United Kingdom reducing its holdings by a substantial $44.1 billion, Japan by $27.3 billion, and Saudi Arabia by $15.1 billion. While the reductions from some countries were smaller in comparison, they were still noteworthy. China's holdings fell by $9.6 billion, Switzerland decreased by $9.7 billion, and India reduced its position by $14.9 billion. These patterns suggest a wider sentiment in the international community, that major foreign investors are wary of the increasing political and economic risks associated with the Trump administration's policies. Historically, foreign governments and institutional investors have closely monitored U.S. policy signals, especially those related to trade, monetary policy, and diplomatic relations. These policy signals are critical because they help investors gauge the potential risks and rewards of holding U.S. debt. If U.S. policy appears unpredictable, confrontational, or geared toward economic isolationism, countries tend to reduce their exposure to U.S. assets to protect themselves from potential volatility. A significant part of this concern lies in the future trajectory of U.S. government borrowing. If major creditors anticipate that the U.S. government will enact policies that could weaken the dollar or inflate the federal deficit, this could make holding U.S. Treasuries less appealing. This concern is particularly acute when global investors predict that U.S. policies may fuel inflation, reduce U.S. economic stability, or increase volatility in financial markets. If the sell-offs by foreign investors continue, this could raise U.S. Treasury yields, which in turn would increase the cost of borrowing for the U.S. Treasury. This situation could have far-reaching consequences, driving up interest rates for American consumers and businesses, including mortgage rates and corporate borrowing costs. Even a modest increase in Treasury yields, combined with expectations of tighter monetary policy, could create ripples through the broader global financial system. It could also influence markets for corporate bonds and government debt in other countries, as investors shift their portfolios in response to rising U.S. yields. A prolonged sell-off by foreign holders of U.S. Treasuries could also challenge the dollar's position as the world's primary reserve currency. While the U.S. dollar has maintained its dominant role in international trade and finance for decades, sustained and significant reductions in foreign ownership of U.S. debt might lead to a shift away from dollar-denominated assets. Countries may increasingly seek alternatives to the dollar, such as the euro, other major currencies, or even precious metals like gold. The December sell-offs may be more than just short-term market movements. They could be a reflection of deeper geopolitical frictions. If the Trump administration's policies result in increased trade barriers, economic sanctions, or diplomatic tensions with major global players, large foreign holders of U.S. debt might continue rebalancing their portfolios into more diversified assets. Such shifts don't always require public announcements or visible actions. Instead, gradual reductions in U.S. Treasury exposure can cumulatively erode the dollar's dominance over time. Looking ahead, if tensions rise or if erratic policy changes contribute to economic uncertainty, the December sell-offs may prove to be a harbinger of a broader, more systematic diversification away from the U.S. financial system. Central banks and sovereign wealth funds traditionally hold U.S. Treasuries as a secure means of maintaining foreign exchange reserves. However, a growing movement has emerged to diversify these reserves in order to reduce over-reliance on the U.S. dollar. This strategy, known as de-dollarization, has been gaining momentum in recent years, with nations seeking alternatives to the U.S. dollar to shield themselves from economic and geopolitical risks. A key driver of this diversification strategy is the desire to mitigate the risks associated with over-reliance on U.S. assets. The use of the U.S. dollar in international transactions has historically given the United States significant leverage over the global financial system, including the ability to impose economic sanctions and restrict access to U.S. financial markets. As a result, many nations are reassessing their dependence on dollar-denominated assets to protect themselves from potential U.S. economic coercion. Countries like China and Russia have been at the forefront of reducing their holdings of U.S. Treasuries as part of broader strategies to diversify their foreign exchange reserves. For example, China's holdings of U.S. debt fell to $760.1 billion in October 2024, the lowest level since February 2009. This move aligns with China's goal of reducing exposure to US dollar-denominated assets and seeking safer, more stable investments to protect against potential shifts in US economic policy. The growing trend of de-dollarization is also reflected in the increased purchase of gold by central banks and sovereign wealth funds. Countries such as Poland, Turkey, India, Iran, and China have been notable purchasers of gold as a hedge against the potential instability of US dollar assets. Gold offers a more tangible and universally accepted store of value, and its price tends to rise during periods of geopolitical and financial instability, making it an attractive option for countries looking to protect their reserves. Beyond gold, currency interventions and domestic economic policies are influencing the global landscape. For example, Japan's holdings of U.S. Treasuries decreased significantly in recent months, from $1.87 trillion in November 2024 to $1.06 trillion in December 2024. This reduction can be attributed to Japan's efforts to strengthen the yen by selling off U.S. dollar assets and buying yen. Such interventions, while aimed at stabilizing a nation's currency, can also contribute to a decrease in foreign reserves held in U.S. Treasuries. Rising U.S. Treasury yields, expectations of higher economic growth, and potential inflation, stemming from policies like tariffs and changes to immigration laws under the Trump administration, have further added to this shift. Higher yields reduce the market value of existing bonds, which in turn prompts foreign investors to reconsider their U.S. debt holdings. Meanwhile, the Federal Reserve's stance on interest rates has also been a contributing factor. The Fed's decision to hold off on interest rate cuts in 2025, largely in response to persistent inflation, has led to a more volatile bond market and contributed to the rising yields. Since the September 11, 2001 attacks, the U.S. has increasingly leveraged the dollar as a tool of economic statecraft, using it to exert pressure on countries through financial sanctions and restrictions on access to the U.S. financial system. While these measures have been effective in certain cases, such as against Iran, North Korea, and Russia, they have also led to a global re-evaluation of the risks associated with relying on the dollar. As a result, several countries are exploring ways to reduce their dependence on the dollar, a process known as dollarization. One key strategy is conducting trade in local currencies, which bypasses the need for dollar-denominated transactions. For example, China and Russia have expanded their use of the yuan and ruble in bilateral trade agreements, while India and Iran have sought similar arrangements to reduce their exposure to the dollar. Another important shift has been the creation of alternative financial systems. To bypass reliance on the SWIFT system, dominated by Western financial institutions, countries such as Russia and China have developed their own financial messaging systems. Russia's System for Transfer of Financial Messages, SPFS, and China's Cross-Border Interbank Payment System, CIPS, are examples of this growing trend. These systems aim to provide greater autonomy in cross-border transactions, allowing countries to circumvent potential sanctions and exert more control over their financial systems. Multinational alliances have also played a role in the push for dollarization. The BRICS group, comprising Brazil, Russia, India, China, and South Africa, has actively discussed creating a new reserve currency to decrease reliance on the dollar. In particular, Russia has intensified efforts to persuade its trading partners to settle transactions in alternative currencies in the wake of Western sanctions. Similarly, Gulf Cooperation Council (GCC) nations have started to consider accepting payments for oil in non-dollar currencies, signaling a major shift in global trade practices. Finally, the diversification of foreign exchange reserves continues to be a significant trend among central banks worldwide. Several countries, such as China, Japan, and India, have been reducing their holdings of U.S. Treasuries while increasing their gold reserves as a hedge against dollar volatility. This diversification strategy reflects a growing desire to protect national economies from the risks associated with over-reliance on the U.S. dollar and its associated financial systems. As nations increasingly boost their investments in alternative assets, they are executing a strategic shift aimed at reducing their vulnerability to economic coercion and the consequences of U.S. monetary policy. This shift reflects a broader movement toward enhancing financial independence. Although the prospect of complete dollarization, where countries abandon the U.S. dollar entirely, remains unlikely in the short term, the trend toward alternative financial systems and currencies continues to gain traction. This growing preference for financial alternatives suggests a long-term transformation in global economic dynamics that is reshaping how nations approach their financial security. The pace and extent of this transformation, however, will depend on a multitude of factors, such as geopolitical developments, the strength of emerging financial networks, and the capacity of countries to collaborate on reducing their dependence on the U.S. dollar. These alternative systems are not merely theoretical. They represent a response to a world in which a single currency, the US dollar, has for decades dominated global trade and finance. Historically, before the US dollar ascended to its current status as the world's reserve currency, the British pound sterling held that prestigious position. The pound's influence was intricately tied to the vast British Empire. The British Empire's global reach, its massive trading networks, and its sophisticated financial infrastructure made the pound the preferred currency for international commerce and finance. By the late 19th and early 20th centuries, the pound sterling was the primary reserve currency for most of the world. However, the financial strains of World War I significantly weakened Britain's economic power. The war effort led to enormous national debt, and gold reserves were depleted to finance military expenditures. This, in turn, undermined global confidence in the pound sterling as a stable store of value. To restore economic stability, Britain attempted to return to the gold standard in 1925, but those efforts were short-lived. The global economy was further destabilized by the Great Depression, which had far-reaching effects, including the forced abandonment of the gold standard by Britain in 1931 after speculative attacks on the pound. These events marked a profound shift in the global financial landscape, eroding the pound's dominance and paving the way for new powers to emerge. At the same time, the United States was gradually emerging as a formidable economic force. The creation of the Federal Reserve System in 1913 provided the U.S. with a centralized banking authority capable of enhancing financial stability. By the interwar period, New York had become a major financial center, rivaling London. The rise of the U.S. economy, coupled with its growing role in global trade, allowed the U.S. dollar to gain increasing prominence as an international currency. The aftermath of World War II was the turning point that saw the U.S. dollar's rise to global dominance. The Bretton Woods Conference, held in 1944, was a defining moment for the post-war international financial system. Delegates from 44 allied nations gathered in New Hampshire to create a new economic order designed to foster international economic stability and prevent the competitive devaluations and protectionist policies that had exacerbated economic instability in the interwar period. One of the key outcomes of the conference was the establishment of a fixed exchange rate system, where the US dollar was pegged to gold at a fixed rate of $35 per ounce, and other major currencies were pegged to the US dollar. This arrangement effectively made the US dollar the anchor of the global financial system. To support the new order, the Bretton Woods Conference also led to the creation of two key international institutions: the International Monetary Fund, IMF, and the International Bank for Reconstruction and Development, IBRD, now part of the World Bank Group. The IMF was tasked with overseeing the international monetary system and ensuring the stability of fixed exchange rates, while the IBRD provided financial assistance to war-torn Europe and supported the development of other parts of the world. By the 1950s and 1960s, the U.S. economy had recovered from the war, and the global confidence in the dollar reached new heights. Central banks worldwide accumulated large reserves of U.S. dollars, cementing the dollar's dominance. However, by the late 1960s, the Bretton Woods system began to show signs of strain. Rising U.S. deficits and increasing global demand for gold created significant pressure on the system. In 1971, President Richard Nixon took a historic step by announcing that the U.S. would suspend the dollar's convertibility into gold, effectively ending the gold standard and marking the beginning of an era of floating exchange rates. This event, known as the Nixon shock, fundamentally altered the global financial system and transitioned the world to a system of flexible exchange rates, where currencies are no longer tied to a fixed value in gold. Despite the end of the gold standard, the US dollar remained central to global trade and finance, largely due to the relative strength of the US economy, the stability of US financial markets, and the dollar's widespread use in international trade, particularly in the energy markets, which came to be known as the petrodollar system. This dollar-centric financial order persisted through the late 20th century, even as challenges to dollar dominance began to emerge. The 1990s marked a period of unprecedented growth and globalization, with the U.S. at the forefront of technological innovations and financial market expansion. During this time, U.S. Treasury bonds became the gold standard for global investors, considered one of the safest assets available. At the same time, the introduction of the euro in 1999 presented a modest challenge to the dollar's supremacy in global finance. Nonetheless, the dollar continued to dominate, comprising nearly 70% of global foreign exchange reserves by the early 2000s. However, the global financial crisis of 2008 marked a significant turning point in the story of dollar dominance. While the crisis initially drove investors to seek the relative safety of U.S. dollar-denominated assets, it also exposed critical vulnerabilities in the U.S. financial system. In response to the crisis, many central banks around the world began to diversify their foreign exchange reserves, increasing their holdings in other currencies and assets, such as gold. Central bank gold reserves, for instance, saw significant growth after the 2008 crash. The crisis prompted countries to reconsider their over-reliance on the US dollar as the central pillar of their foreign exchange reserves. Simultaneously, China has been actively pushing for the internationalization of the renminbi, RMB. One of the key initiatives in this effort was the creation of the Asian Infrastructure Investment Bank, AIIB, in 2014, which was designed to provide development funding across Asia, offering an alternative to Western-dominated institutions such as the World Bank. Through projects like the Belt and Road Initiative, BRI, China has invested heavily in infrastructure projects across multiple continents, many of which are financed in RMB, thus increasing the global use of the Chinese currency. China has also entered into numerous bilateral currency swap agreements with other nations to facilitate trade and investment in currencies other than the US dollar, further reducing its dependence on the dollar. At the same time, the rise of blockchain technology and digital currencies has created both challenges and opportunities for the established financial system. Many central banks around the world are exploring the creation of central bank digital currencies, CBDCs, to modernize payment systems and counter the rise of private cryptocurrencies. As of January 2024, over 130 countries, including the US, were exploring or already developing their own CBDCs. China is leading the charge with the digital yuan, ECNY, which aims to enhance payment efficiency and strengthen the global profile of the renminbi. The digital yuan could streamline cross-border transactions, providing a viable alternative to a dollar-centric financial system. Meanwhile, cryptocurrencies like Bitcoin and dollar-backed stablecoins are increasingly being used in international transactions, reinforcing the dollar's role in the digital economy while introducing new dynamics into the global monetary system. By 2022, the US dollar's share of global foreign reserves had declined to approximately 58%, with other currencies such as the euro and Chinese yuan gaining prominence. This shift away from the dollar reflects a broader trend of diversification in global financial systems. One notable trend in recent years is the decline in US Treasury holdings by countries like China. In 2013, China held roughly $1.3 trillion in US Treasuries, but by 2024, its holdings had decreased to around $759 billion. This reduction is due to several factors. China's trade surplus with the US has decreased, diminishing the need for the country to accumulate dollars and invest in US Treasuries to maintain its currency peg. In addition, geopolitical tensions, particularly between the US and China, have prompted Beijing to reduce its exposure to US debt as a way to minimize risks associated with potential political friction. This strategy not only helps China reduce its reliance on US financial assets, but also positions the country to potentially benefit from a large-scale sell-off of US debt, which could drive up the value of the Chinese yuan while putting downward pressure on the US dollar. In conclusion, while the global financial system remains heavily influenced by the US dollar, shifts are occurring that could eventually lead to a more diversified monetary system. As nations increasingly seek financial independence through alternative assets, currencies, and systems, the future of the dollar's dominance is far from certain. However, it remains to be seen how these changes will unfold, influenced by geopolitical shifts, technological advances, and new financial innovations that are reshaping the global economic landscape. China's share of the total outstanding US Treasuries has significantly diminished over the years. Back in 2011, China held around 14% of all outstanding US Treasuries, reflecting its substantial role as one of the largest foreign creditors to the US economy. However, by 2024, China's stake in US Treasuries had fallen to under 3%. This marks the lowest level in 22 years, and the decline underscores broader shifts in global financial dynamics, with China gradually moving away from reliance on US debt as part of its long-term economic strategy. The reduction in Chinese holdings can be attributed to a combination of factors, including efforts to manage its own economy more independently, diversify its foreign exchange reserves, and reduce its exposure to potential US policy risks, such as fluctuations in interest rates and currency valuations. Meanwhile, Japan's holdings of US Treasuries have seen a slight decrease, dropping from $1.167 trillion in March 2024 to $1.159 trillion in December 2024. Despite this modest reduction, Japan remains the largest foreign holder of US Treasuries, a position it has maintained for several years. Japan's foreign reserve management is heavily influenced by its efforts to stabilize the Japanese yen, which has experienced significant depreciation against the US dollar. To counter the yen's decline, the Bank of Japan has occasionally sold off portions of its U.S. Treasury holdings. Additionally, Japan's domestic fiscal policies, such as yield curve control, which aims to cap interest rates, and measures to curb inflation, have also shaped its approach to managing foreign reserves. Japan's reserve management is therefore a balancing act between maintaining currency stability, responding to domestic economic pressures, and navigating global financial markets. Following President Donald Trump's re-election in November 2024, the United Kingdom experienced a notable decline in its U.S. Treasury holdings, which fell from $766.8 billion to $722.6 billion. This decrease is the result of several interrelated economic and geopolitical factors. The Trump administration's proposals for substantial tax cuts and increased fiscal spending triggered concerns about rising inflation and increased government borrowing, which in turn pushed U.S. Treasury yields higher. As bond prices move inversely to yields, the value of existing U.S. Treasury holdings diminished, prompting many foreign investors, including the United Kingdom, to reassess their positions in U.S. debt. The period after the election saw significant sell-offs in global bond markets, influenced by fears of inflation due to anticipated policy changes in the U.S. and strong economic indicators. In addition to these economic shifts, the UK and other countries have been diversifying their foreign exchange reserves away from US dollar-denominated assets like Treasuries. They've increased their investments in alternative assets such as gold and other commodities, which offer a hedge against the volatility of the dollar and geopolitical risks. The appreciation of the US dollar, driven by expectations of pro-growth policies under the new administration, also influenced these strategic shifts, as foreign-held assets in dollars become less valuable when converted back to local currencies. India's U.S. Treasury holdings saw a decrease from $240 billion in March 2024 to $219 billion. This reduction aligns with the Reserve Bank of India's (RBI) active management of its foreign exchange reserves, particularly its efforts to stabilize the Indian rupee, which has faced significant pressure from global economic volatility, rising U.S. interest rates, and capital outflows. In recent years, India has been focusing on diversifying its foreign exchange reserves, including increasing its gold holdings and exploring other asset allocations. This diversification strategy is part of India's broader approach to reducing its reliance on US dollar-denominated assets while strengthening its trade relationships with emerging markets. By building more robust economic ties with countries outside the US sphere, India aims to protect its economy from potential vulnerabilities tied to the global dominance of the US dollar. Saudi Arabia, a major oil exporter, also saw a decline in its U.S. Treasury holdings, which dropped from $142 billion to $137 billion over a 6-month period. The kingdom's foreign exchange reserves, and particularly its U.S. Treasury holdings, are closely tied to the fluctuations in global oil prices, as oil exports form the backbone of its economy. The recent decline in holdings likely reflects a combination of lower oil revenues and strategic financial planning by the Saudi Arabian Monetary Authority. Saudi Arabia has been pursuing economic diversification through its Vision 2030 initiative, which aims to reduce the country's reliance on oil revenues by investing in infrastructure, technology, green energy, and other sectors. Furthermore, Saudi Arabia's enhanced financial ties with China and other trading partners might be driving the kingdom to reallocate some of its reserves away from U.S. Treasuries toward other investments that better align with its long-term economic goals. This reflects a broader trend of diversification in global reserves, with countries seeking alternatives to U.S. debt as they hedge against economic and geopolitical uncertainties. Germany's holdings of U.S. Treasuries have dropped from $14 billion to $9.7 billion within just 6 months. As the largest economy in the Eurozone, Germany's foreign exchange reserves, managed by the Bundesbank, include a portion of U.S. Treasuries. The slight reduction in holdings could be attributed to several factors, including concerns over inflation and shifts in European Central Bank monetary policies. In addition, Germany has been increasingly focusing on sustainable investments, with growing allocations to green bonds as part of its commitment to long-term economic sustainability and climate goals. The reduction in U.S. Treasury holdings might also reflect Germany's ongoing efforts to strengthen the euro's position as a potential alternative to the U.S. dollar in global financial markets. As Europe looks to diversify its reserves, the euro could play a larger role as a reserve currency, challenging the dominance of the U.S. dollar. Norway, known for its substantial sovereign wealth fund, also made adjustments to its U.S. Treasury holdings. Between August and December 2024, Norway's holdings decreased from $66 billion to $57 billion. The fund, officially known as the Government Pension Fund Global, manages a diversified portfolio that includes equities, fixed income securities, and alternative assets. The modest decline in U.S. Treasury holdings reflects Norway's broader investment strategy, which responds to global interest rate changes and aims to balance risk with long-term financial stability. As global interest rates rise, Norway has been reallocating capital toward higher-yielding investments, further diversifying its portfolio and mitigating the risk of overexposure to low-yielding U.S. debt. In conclusion, the global landscape is shifting in response to new tariffs and increasing economic uncertainty. The U.S. has recently implemented reciprocal tariffs of 25% on all countries, along with targeted tariffs on key industries such as automobiles, semiconductors, and pharmaceuticals. These measures could accelerate the sell-off of U.S. Treasuries as affected countries attempt to reduce their exposure to U.S. debt. Selling off U.S. Treasuries allows nations to both retaliate against trade restrictions and reallocate their reserves toward alternative assets like gold, foreign currencies, or infrastructure investments. This trend of dollarization is gaining momentum as countries diversify their reserves to mitigate risks associated with over-reliance on U.S. dollar-denominated assets. The current economic environment is highly unpredictable, and escalating trade tensions between the U.S. and other major economies have created an uncertain outlook. If these trade policies intensify, they could trigger increased market volatility, disrupt global supply chains, and exacerbate inflationary pressures. On the other hand, supporters of these measures argue that they could eventually lead to fairer trade practices and a more balanced global economy. Whether these policies contribute to stability or result in further economic fragmentation remains to be seen, especially as global trade dynamics evolve. The long-term impact of these tariffs is difficult to predict, but we may witness significant shifts in trade alliances, reserve currencies, and global financial markets. For now, it's crucial to continue monitoring these developments closely, as they could either contribute to economic stability or propel the global economy toward greater uncertainty and fragmentation. These shifts have the potential to redefine how countries manage their financial reserves and interact in the global economy in the coming years. That's all for today's video. Thank you for watching. We sincerely appreciate your time and engagement with our content. If this video resonated with you or sparked some new insights, please consider liking it and subscribing to stay updated with our latest content. Your support is invaluable to us. Be sure to check out another video from our channel now appearing on the screen.